I'm happy to introduce you to Patty Silverstein, well-versed on the local economy. Patty is the consulting chief economist for the Metro Denver Economic Development Corporation, author of the Chamber's monthly Economic Indicators Report, and also president of Development Research Partners, a real estate analysis and economic development research company. We're also honored that she has become a staple of Vectra's annual economic forecast. Please welcome Patty.
Good morning. I am delighted to be back here again to talk about the economy with you. What better way to start our day, right? So I want to talk about the economy today in terms of intersections. How our economy, how the employment situation intersects with population growth, how our population growth intersects or connects with the housing market, all of these kind of interrelationships that we see out there. And certainly one of the other aspects that I want to take a look at today is that, like any good business, you need to know what your competitors are doing. So today I want to share with you too how Metro Denver's competitors are doing. Because in the economic development world, certainly we want to know how indeed our market compares to those other markets. So starting first of all with employment, we're going to touch on such issues as employment growth, our industry clusters, and what's going on with our average salary, and how this all relates to our commercial real estate market. Starting first of all at the broad level of what's going on here within the state of Colorado. So these are all of the states that border Colorado on this chart, just a kind of a regional feel for how the economy is doing here. Notice that in Colorado, we went from number 41 in terms of the employment growth rate, which felt really bad. Remember that back in 2010? Ooh. That was followed in 2014 by zooming up to number 3 in terms of employment growth. Now for 2015, we're kind of settling in this top 10, top 15 type of mark. All of these figures will be revised in March, so we'll have a better sense really then. But we're still probably, we're still doing pretty well here in Colorado. I want to draw your attention though to one of our key competitors, Utah. Look at that. Utah is at number 1 in terms of employment growth right now. We pay very close attention to what's going on there in Utah because they have been coming on strong with a very diversified economic base. They've seen a lot of entrepreneurial activity, innovation going on there. So we're definitely keeping a close eye on them. Now, last year's number 1 state is not a state that borders on Colorado. Last year, actually in 2014, the number 1 growth state was North Dakota. North Dakota had held that number 1 position for the past 6 years. And you know what? In 2015, they fell to number 46. Certainly shows the influence that oil and gas can have on our economy. And certainly that is one of the issues that we're looking at here in Colorado. And indeed, when we take a look at all of our metropolitan statistical areas in Colorado, we see a very different picture this year from the 2015 data than we did in 2014. That Greeley area, which is essentially Weld County, went from a 9% growth rate to about a 5% growth rate. Again, that has been really where the bulk of the oil and gas activity in the state has been focused most recently. So the decline in that growth rate was expected. What it continues to boost that whole Weld County economy, however, is the clean tech side, the alternative energy side, where we continue to see Vestas growing by leaps and bounds there within that area. So certainly that's been kind of a good news, bad news story for the Weld County area. Notice there too, the Grand Junction has been kind of growing at the slowest pace here in the state of Colorado. They have had difficulties in trying to diversify their economic base following the prior oil boom periods. So they're still challenged by that, but nonetheless, they are back onto a growth track once again. Here in the Metro Denver region, where we represent over 60% of the jobs, we have a very diversified economic base, and indeed the activity that we see going on within the Metro Denver region tends to drive what we see going on all throughout the state. So how does Metro Denver compare then to the U.S.? So notice first of all, that in Metro Denver, we recovered all of the jobs that we had lost during the Great Recession by the beginning of 2013. And indeed, 2013, 2014, very strong growth years for our region, that, at rates of over 3.5%. This was a period of time when throughout this whole Metro Denver area, and by that I'm generally talking about a 7-county region that goes from Douglas County on the south all the way up into Adams and Boulder counties on the north. So within that whole 7-county region, over the 2013 and 2014, we added roughly 50,000 net new jobs each year. So notice now in 2016, we do expect a slightly slower employment growth rate, down to that about 2.9%. This means we're going to be adding more along the lines of about 45,000 net new jobs. So nonetheless, still a nice addition to our employment base here within the metro region. So how are our competitors doing? So amidst this crazy chart here, I want to point out a couple of things. First of all, all of our competitors are of different sizes. So we're indexing the employment prior to the recession to a value of 100 in June of 2007. And then we can then see when values go above the 100 line, that means that they've been expanding. When they're below that, they're still contracting. A few words about who our competitors are. So by the competitors, we're looking at these areas of the country that we typically compete against for job expansions and relocations. So when a company is considering, okay, if I'm going to open up a new facility, should I open it up in the Metro Denver area? Should I open it up in Portland? Should I open it up in Austin, Salt Lake City? These are our key competitor locations as these companies are making these plans to grow and expand. You will notice that there are no California cities on the list. We have a very different relationship with California. Oftentimes it's that San Francisco company, that Los Angeles company that is thinking of expanding outside of that marketplace and wondering, should I put my facility in Metro Denver? Should I put it up in Portland? So that's why very different relationship there, and that's why we don't have them on this chart necessarily. So a few things to notice about this. Austin was hardly even touched by the Great Recession. They have continued to grow and expand their employment base all over the years. Dallas was also one of the first areas to come out of the Great Recession. They bobbled a bit during the recessionary period, but then they were one of the first to come out. And notice now Metro Denver and Salt Lake, we have been neck and neck in terms of employment growth rates. So again, it's very important then that we pay attention to what these areas are doing as well. And then there's Phoenix down there in the orange. Notice that it was not until the last few months, really, that Phoenix recovered all of the jobs that they had lost during the Great Recession. So why do we think the Metro Denver region is performing so well? Why indeed were we one of the first areas of the country to come out of the Great Recession and go on to this whole new growth track within our area? Well, we believe that it's really because of our focus on our industry clusters. Our economic development strategy in the Metro Denver region relies very heavily upon these industry clusters. These are the industries that as they start to increase, it lifts up the entire economic structure here in the Metro Denver area. And notice now there are 9 industry clusters because we have added a new one, beverage production. And I know you're thinking, yeah, it's all the beer. It's not just beer. Okay, certainly our large breweries, all of our craft breweries that we have here, very important to our economic base, and definitely helping to increase our whole employment base here. But it's also sports drinks, soft drinks, wineries, distilleries, milk products, coffee, tea. All of these beverages that are being produced in this region really bring us to one of the very strongest concentrations of employment in the country. Indeed, the Metro Denver region ranks 3rd in terms of employment concentration when it comes to all of the beverage production. So you may remember this industry cluster chart, this bubble chart. Just to get your bearings on this, on the bottom axis then is the growth rate in the various industries over the past year. And you will see by looking at that far right side, clean tech. Again, that's the alternative energy, renewable energies, has been the fastest growing industry cluster here in the Metro Denver region over the past year. The prior year, it was fossil fuels, because in our industry clusters, we actually wrap in Weld County and Larimer County into the information. So it had been fossil fuels that had been growing the most rapidly. Still saw a little bit of growth occurring in the fossil fuel category in 2015, but we expect that that is going to probably contract a little bit more in 2016. Now, the size of these bubbles represents the size of the employment base. You will see that the healthcare and wellness bubble, that big pink bubble, is indeed our largest employment base here. This has been an industry that has been just continuing to grow and expand over the past 12 years, a very consistent performer within our region. The lime green bubble there is our beverage production side. Again, as I had said, we have the third strongest concentration of employment in the beverage out of the 50 largest metropolitan areas in that beverage production cluster. And indeed, when we take a look at our output here in Colorado, just in terms of the beer category, again, our large breweries as well as our craft breweries, we see that we are number one in per capita output in the country. Up and down on the chart then is our location quotient, which refers to that strength of that employment concentration. You will see that aerospace is still up there at 4.5, meaning that our employment concentration in aerospace 4.5 times the national average. Indeed, Colorado has one of the largest aerospace bases in the country. We zoomed up to number 2 again. Okay, we're number 2. Last year we were number 3. We added a few employees, and our next closest competitor did not add at quite as rapid of a pace. So we are now, once again, the number 2 aerospace economy in the country, which we are pretty excited about, second only to the state of California. Now, I could talk for hours about all of the clusters and about all of the key trends that we see going on within these clusters, but Bruce wouldn't give me enough time to do that. So instead, I encourage you that if there are any of these industries that you want to find out more information about those key trends, who the key players are, the workforce issues, that type of thing, go to www.metrodenver.org. We have full cluster reports on all of these. They're available at no charge. Again, lots of great information that is out there. So these are employment growing and expanding, but you've all heard that all we're doing are adding all these low-wage positions, right? Not true. Here in the Metro Denver region, we have the highest average salary of any of our competitor locations, and indeed, our average salaries have been increasing at a faster pace than all of our competitor locations. So certainly as our industry clusters increase, we are leading again to an increase in our overall employment base, an increase in the overall wages that we have seen within the region. And as I'll talk about in a moment, those wages we expect to be growing at a continued strong pace. So what does this mean for our commercial real estate markets? As Bruce had mentioned, yes, we have indeed seen very strong real estate markets here in the Metro Denver region. In fact, when we take a look at office, industrial, retail in general, we have been seeing declining vacancy rates and increasing average lease rates. We did see a little bit of a bobble in the industrial side where that vacancy rate actually went up by 0.1%. But again, that industrial market has been very, very tight. So that little bit of increase in that vacancy has actually been very welcome within the region because, as many companies can attest, it has been very difficult to find the type of industrial space that is needed in our marketplace. All of this is leading to more construction activity. In total, we have over 5 million square feet of new office, industrial, and retail space that was completed in 2015, and about another 7 million square feet that continues under construction. The construction industries will tell you that it is challenging for them to find the workers that they need to complete all of this space right now, because again, we have this very low unemployment rate within our region. So how does this employment growth then connect with the population expansion that we are seeing here within the Metro Denver region? Well, the greatest connection is through that unemployment rate. Notice that the unemployment rate in our region has declined to our pre-recession value of 3.8%, and it is expected to continue to go down in 2016. We expect about a 3.5% unemployment rate in the area. So for our companies out there, it is challenging to find those workers that you need. You have to get a little creative in terms of retaining and attracting those workers there. So you may have to start to see a bit up in wages, a bit up in benefits, a bit up in amenities that are offered to the workers to try to lure them to your company. Because of this, we are seeing then an increase in our population base. As people look out across the country and say, where can I see better opportunities for myself, my household? The Metro Denver region has certainly been one of those areas that is top of mind. We have been a region that has been attracting all of those millennials as well as other generational groups, but certainly the millennials have been migrating into the region in a very strong manner. The migration activity is demonstrated by the gray part of that bar. The green part reflects our natural increase. So even if nobody moved in or out of the region, we'd continue to see an increasing population, but it is indeed that migration activity that tends to drive a lot of our economic performance here as well. So all of these folks that are moving into the Metro Denver region, they need some housing, right? We have seen a very consistent performance in our home sales market. We've been, selling around 56,000 homes per year. Again, that represents maybe about 18 home sales per thousand, which is a little bit above our historic norm. Our historic norm is about 17, but certainly much better than the depths of the recession when we're only selling maybe about 13 homes per thousand people. So a very consistent type of sales activity. But the challenge is it's gotten a little pricey here. Median home price in the Metro Denver region now at about $350,000. That means half of the homes sold are selling less than that, half of the homes selling for more than that. We have seen in 2015 nearly a 13% increase, 13% appreciation in our home prices. And notice that difference between the Metro Denver median price and the national home price has indeed gotten wider. So this is really what I feel one of our greatest challenges is for the growth in our region is the affordability of housing within the region. And so some of you may say, well, if you can't afford to buy a home, let's just rent. We'll take a look at that in a moment. But on our competitor side, notice here that the Metro Denver region, we have the highest median home prices of our competitors, and they have been increasing at a faster pace. So again, on the Phoenix side, not to be picking on Phoenix here by any stretch but in Phoenix, their home prices have not even recovered to the point that they had been. Our closest competitor in terms of that pricing point here is probably Portland. And Portland has now been ranked as about the second fastest growing economy in terms of home prices recently. So Portland is coming on strong. Austin home prices have also been increasing at a very fast pace. So again, like I say, in case you're thinking that, well, gee, I really can't afford to buy a home, I'm just going to rent. The rental market here in the Metro Denver regions remains very tight. We did see an increase in that vacancy rate, that apartment vacancy rate in the fourth quarter, up to about 5.0%. up to, increased to over 5% then in this current quarter, averaging about 5.3% throughout all of 2015. So we're seeing some loosening in the market as we have seen new homes come online, new apartment complexes that have been opening, but still a relatively tight marketplace. Indeed, this is leading to apartment rental rates that are quite high for a lot of people, again, to afford. We're looking at an average apartment rental rate of just under $1,300 in the metro region. These prices are ranging from about $1,200 in Adams County up to about $1,500 per month in the Boulder-Broomfield marketplace. These are the averages for all types of units, everything from the efficiencies on up to the 2-3 bedrooms. So certainly if you're going for larger types of properties, you're going to be paying significantly more than that. So what are we doing then to try to temper some of those price increases? Well, certainly in the marketplace now, we are building additional product. In fact, when we take a look at the number of single-family and multifamily units coming on board in the Metro Denver region, we'll see that we're at about 18,000. Our historic average is about 17,000 units, so we're finally building up at a level up above our historic norm there. We've seen a bit of an increase recently, again, in single-family detached units. Notice that multifamily had represented the bulk of the marketplace. Upwards of 58% of the new units that were coming on board were multifamily units in 2012. That's back down to about 43%. Our historic norm would put us at 25%. So I don't think that we're going to return to the days of that 25% mark, certainly because of the changes in our demographic structure here. The millennials, the baby boomers, are looking for more of those carefree types of options when it comes to housing. So we'll continue to see more of that multifamily construction. But nonetheless, we're starting to see a bit of an equalization or a return to normalcy, maybe a return to routine when it comes to the types of units that are being constructed in the region. So the new people coming in here, they're just clogging up our roads, right? Well, according to the Texas Transportation Institute, our level of congestion now is no worse than it had been prior to the Great Recession. You believe that? Okay. Anyway, that's according to the data in terms of the number of hours of delay. So what are we doing to remedy that situation? Well, we have fast tracks. 5 new segments of fast tracks coming online in 2016. We have the Flatiron Flyer, that is that bus rapid transit line between Boulder and Union Station. We have Line A, the A line, coming from Denver Union Station out to Denver International Airport, opening in the spring. That presents great new opportunities for businesses, for tourists, for all of us in terms of accessibility, mobility throughout our region. And then we have the B line to Westminster that'll be opening up in the summer. The G line, which is that Wheat Ridge Arvada line, that will be opening up in the fall. And then in winter, the R line along I-225. This is changing the development patterns throughout Metro Denver. It's changing our mobility patterns throughout Metro Denver, providing some great opportunities for us to really propel us, to give us that mobility that we need to move on into the future. With that, thank you so much. Have a fabulous 2016.